When you're investing you need to look for ways to reduce risk or to mitigate what? Risk. Again, people don't understand that risk drives return. Okay, when I say risk drives return, what actually determines the returns you receive when you invest is the kind of risk that you take. Okay, so if you take impossible risk, then you're going to get impossible what? Returns. And those are returns that will likely not materialize. Okay. If you take too much risk when you're investing, if you're investing in vehicles that promise you 12% a month, 15% a month, that is outrageous. Nobody can really generate such returns for you with guarantee. Okay? And in situations or cases like that, you are likely to lose what? Your investments. Okay, so when you're investing, you shouldn't look for extreme returns, because if you do, then you are asking for extreme what? Risk. Okay, if you are looking for extreme returns, then you are also asking for extreme risk. And if you go in for extreme risk, you may lose all your money that you had invested. Okay, so basically that is about risk and returns. Now, because risk drives returns, when we are investing, the natural thing to do then is to try to minimize what? Risk. Or to try to mitigate what? Risk. Okay, so what are some of the measures you can use to mitigate risk? One is risk avoidance. Don't take any risk at all. But in this life, that is also something that you really cannot afford to do. Okay, there are people who say, oh, I won't take a plane. I don't want to fly. I'm scared of traveling. But you may be in your house, and this happened, I think, a few years ago at 37, and a plane can come and injure you. Okay, so avoiding risk is also not a very good option to take. Okay, so for example, if you are investing and you want to avoid risk, then you don't really put your money in risky vehicles, or you don't put your money in instruments that promise or give high returns. In such a case, you could, for example, put your money in a bank account where the risk is minimal or where the risk is what? Is low. Okay, so that is risk avoidance. The next strategy is what we call risk anticipation. And that is wise to do because we know that risk will occur, we know that risk will happen. So what you can do is to anticipate or plan for the risk so that when the risk materializes, it doesn't put you in an uncomfortable situation. Okay, so when you are investing, one of the risk mitigation strategies is to have what we call an emergency fund. Basically, this fund allows you to invest in instruments like treasury bills. Okay, so low risk, equivalently the returns are also low, but your money is more or less guaranteed. Okay, you're not likely to lose this money. Okay, so one, you can have an emergency fund. Another risk mitigation measure is having life insurance. Okay, so, well, if you're a daredevil, maybe you don't want to insure. Okay, but the essence of having life insurance is that, for example, if you pass on prematurely, then there's some money there for your dependents. Okay, so that's also a risk mitigation measure. And usually in a very good or optimal portfolio, you need some level of insurance in that portfolio. Okay, so one, is good to have an emergency fund. Two, is good to have what? Life insurance. Okay, that helps to, in a way, put some shock absorbers into your investment strategy. Then next is what we call risk transfer. Okay, so if you can't absorb the risk, there may be parties who are better able to take on this risk. Okay, so again, one way to transfer risk is to use insurance. There are also more complicated vehicles, like what we call derivatives. Okay, so for example, if you are scared that the stock market will crash, you can buy a put insurance that, in essence, gives you protection against a stock market crash. Okay, so another way to manage risk is to transfer risk to a third party who is better able to manage what? That risk. The final strategy I'll discuss is what we call risk reduction. Okay, and with risk reduction, what you do is that in investing, you're trying to diversify your portfolio, i.e., in layman language, don't put all your eggs into what? one basket, because if you do, what may happen? The basket may fall, break, and you may lose all your eggs. Okay, so don't put all your eggs in one basket. To bring it home when you're investing, it means that you should spread your investments across various asset classes. So you can buy treasury instruments, you can buy treasury bills. Okay, treasury bills are still treasury instruments. You can buy equity instruments. And there are other categories of investments that you could buy, like private equity, hedge funds, etc. A number of these are not yet available in Ghana. But try to diversify across instruments, so buy treasury instruments, buy equity instruments. Try to diversify across sectors. Again, I like to tell people that I don't like to time the market, I wish I had perfect foresight, that I can tell that, oh, today maybe this sector will do well, or that company will do well. But the honest truth is that we don't. Okay, and in the absence of perfect foresight, it makes sense to diversify. If you don't know which sector will be the star sector, let's say this year or next year, then maybe spread all your eggs across the different sectors. That's a sensible strategy to undertake. Or you're not sure of interest rate directions. Okay, some people want to bet on the interest rate. If interest rates are increasing, you want to do short-term instruments. If interest rates are reducing, you want to do long-term instruments to lock in the interest rate. But again, we don't have perfect foresight. We don't know what the interest rate will be tomorrow or in 6 months' time. Okay? And therefore, in a scenario like this, it makes sense to, again, diversify. So put part of your money in the short-term end of the market, and also put part of your money in the long-term end of the market. Okay, so these are some of the risk mitigation strategies.